The US dollar has been devalued and is now only worth 1/3,300th of an ounce of gold. It's the dollar falling more than it is gold rising. Now, gold will rise in value during these periods of time when it's basically revaluing itself. Now, China's new physical gold mandate for insurance companies will reshape the world's gold market. China's insurance regulator now requires major insurers to allocate 1% of their assets to physical gold, creating unprecedented structural demand. This move is explicitly funded by reducing U.S. Treasury holdings, accelerating China's de-dollarization, and shifting global gold market dynamics.
China's new gold mandate marks the beginning of a seismic shift in global markets, tightening supply and accelerating the process of de-dollarization. Mike Maloney explained that regression analysis shows retail sales of gold and silver have been trending lower since 2008, despite an initial surge following the financial crisis. Now, however, structural demand is being reshaped by policy. China's insurance regulator has introduced a rule requiring major insurance companies to allocate 1% of their assets into physical gold. This allocation is being funded by reducing U.S. Treasury holdings, effectively speeding up de-dollarization while creating a powerful new source of steady demand. At current prices, that mandate alone would absorb 15 to 20% of annual global mine supply, a massive impact on a market already constrained by limited new production. Maloney stressed that gold remains deeply undervalued when viewed through an inflation-adjusted lens. Using older methodology, the 1980 high in gold would equal about $35,454 per ounce today, while silver's inflation-adjusted high would be around $1,640 per ounce compared to just $40 today. This sharp contrast underscores how much room both metals may have to move higher. He also pointed to Japan, where gold has recently broken above 500,000 yen as the currency collapses under the strain of the world's highest debt-to-GDP ratio. With Japan forced to choose between printing money or facing economic collapse, Maloney argued that gold will inevitably emerge as the clear winner. Indeed, gold priced in yen has already tripled over the past 5 years. Before we explore Mike Maloney's perspective on gold, silver, and the shifting global monetary system, make sure to like this video, subscribe to the channel, and tap the bell icon so you never miss the latest updates.
If you take a look at this, what he's done is he's done a mathematic regression here, and it shows declining sales. Since 08, it ramped up right after 08, but both gold and silver have been falling in retail sales. And I just, the whole reason I started goldsilver.com and wrote the books and everything is to try and protect people from government stupidity. And I believe, that I have done some of that. I've made a small difference. So we're going to show some of the demand drivers now. China's new physical gold mandate for insurance companies will reshape the world's gold market. So Avery Goodman, and this is also, this is just a few days old, actually. So, a couple of weeks. China's insurance regulator now requires major insurers to allocate 1% of their assets to physical gold, creating unprecedented structural demand. This move is explicitly funded by reducing U.S. Treasury holdings, accelerating China's de-dollarization, and shifting global gold market dynamics. The mandated gold buying at current prices will absorb about 15 to 20% of annual global mine supply. 15 to 20% of annual global mine supply, supporting a significant price increase due to limited new supply. Yes, it would. This percentage will get smaller as price goes up. Given stagnant mine output and rising institutional demand, gold prices are likely to rise significantly above current historic highs in the coming years. Absolutely. If this demand that is mandated, that insurance companies do this, right now it's 15 to 20% at these prices. But this is like an impossible situation. The prices have to rise for that 1% of their yuan-denominated assets to be allocated toward gold. Moving on, Eric Jung, Indian pension funds might invest in gold. Florida signed a bill into a law allowing people to make transactions using gold and silver. So gold and silver is being remonetized. I mean, nobody's doing it yet. Do you have to make them at face value on the coins of $1 for a silver eagle and $50 for a gold eagle, which is crazy? Or can you make them at the current spot price? That would be awesome. Here's the Ron DeSantis announcing it. Gold just broke 500,000 yen in Japan. The yen is getting torched, and gold is going vertical. Japan's debt to GDP is the worst in the developed world. Their only option, print or collapse. Either way, gold wins, and that is absolutely true. And gold in Japan has tripled since the beginning of this chart. In just the last 5 years, gold has tripled in Japan. You may have heard Rick Rule say that global allocation to gold has dropped to 0.5% in recent years, while the multi-decade average is 2%. Now, I've heard and seen measurements where gold was actually 8% of global financial assets when it was in a bubble in 1980. So a mere reversion to the mean would quadruple investment demand for gold. A reversion to a bubble like 1980 would be 16 times the investment demand. So the price would have to go astronomical. Well, here's the evidence it may be starting. Hong Kong investors triple gold holdings in rush to save haven, according to Hong Kong Shanghai Bank Corporation. But here you've got gold with the shadow government statistics alternate CPI, which I want to remind everybody is just the U.S. government CPI. It's their methodology used from World War II until 1982, when they turned the CPI into the CP lie, and they've been fiddling with it ever since. Now, I do believe that both government methods are wrong, and that the truth lies somewhere in the middle, but the original CPI is much closer to the truth than the new CP lie. But this has, you can see that gold is still an extreme bargain, and the shadow government statistics alternate CPI, adjusted for inflation, the 1980 high is $35,454 an ounce, excuse me. And if you want to take a look at silver, this is really something. So silver, look at where it sits. It is an extreme bargain at just about $40 an ounce. Because the high in 1980, inflation adjusted, is $1,640. If the resources, if the gold belongs to somebody else, then yes, there is a lack of resources. And then there will be no bubble phase in this gold market, and this is entirely possible. So Grady, or however you say your name, I'm not sure, Grady, he could be absolutely right, because this time around, after the present third final bull move, the world will have a new monetary system backed by gold. Boy, I sure hope not. A monetary system backed by gold is a gold standard. And I mean, I've said many times, gold is great. Gold standards suck. What we need to do is get rid of the words dollar, yuan, yen, pound, euro. We need to get rid of those words and replace them with grams, nanograms. That's the word. That's what we should be using. If the world used gold instead of these hocus pocus the gold standards open the door for the scam to start all over again, this fractional reserve scam. So anyway, this will pin gold at the highs value-wise, meaning there is no bubble. It'll pin gold at the highs price-wise. But if the dollar still exists, they'll continue printing more dollars than it'll be connected to gold somehow. But it's always a fractional reserve scheme. Jim Rickards believes that it should be a 40% reserve ratio. Well, that's where we were when the Federal Reserve started, but then we went on to the Bretton Woods system with no reserve ratio. And that means this is not only a normal bull market, it is also a global monetary system reset. It's vital to grasp that this is not going up, it is mostly currencies depreciating. It is. So for heaven's sake, do not miss it. And I agree with him. I don't recommend anybody buy gold, but that's what I'm doing. Gold and silver. And I let the gold-silver ratio dictate which I buy. But he shows this 2,400% move back in the 70s, and then these second bull move, third bull move, and so he's considering this one big bull market. And it's a proper way to consider this because, since Nixon took us off of gold, and took the world off of gold when he ended the Bretton Woods system.
Mike Maloney highlighted a troubling disconnect between GLD's physical gold inventory and the rising gold price, raising concerns over who may be quietly withdrawing gold from the ETF. He also pointed to reports that Donald Trump has been considering bold gold-related policies, including the issuance of gold-backed U.S. Treasury bonds, to challenge the Federal Reserve's dominance and restore confidence in the dollar. Maloney warned that the current paper-based system only functions if investors do not demand large-scale physical delivery. If such a scenario were to occur, the market would be unable to cover all outstanding claims, potentially triggering a panic that could propel gold prices to $25,000 an ounce almost overnight. Drawing on Jim Rickards' research into Fort Knox and the mechanics of gold leasing, Maloney explained how central banks and major institutions rent out gold for interest, creating long chains of paper contracts without moving the physical metal. This system is essential for Wall Street giants like J.P. Morgan and Goldman Sachs, but it conceals the true scarcity of actual supply. For ordinary investors, the takeaway is much simpler. Maloney personally continues to buy and hold physical gold and silver without selling. In his view, the price of precious metals is being artificially suppressed by paper games. And once physical demand inevitably collides with limited supply, their real value will be revealed. Let's get back to the interview.
GLD, gold inventory tonnage versus the gold price ratio at its lows. So this is it, and it just shows I don't trust GLD. The price is going up, the tonnage is sort of flat. That causes the ratio to go down, meaning that the gold price is making new highs while GLD physical gold inventory is hovering at its intermediate lows. Who is sucking physical gold out of GLD? Thanks, Nick Laird, for the wonderful charts. So gold charts are us, or on X, it's Goldfish charts. Moving on, gold revaluation, Trump's red button option. And Trump eyes radical gold idea to expose the Fed and anchor the dollar. And this is about issuing gold-backed U.S. Treasury bonds. Forbes talking about the secret weapon Trump can use to take on the Fed. And he keeps on trying to take on the Fed. The logic of auditing America's gold, the measures reintroduced in Congress, is aimed to restoring confidence in a greenback, the value of which has plummeted below 1/3,300th of an ounce of gold. I'm glad that people are starting to finally state this in the proper terms, that the U.S. dollar has been devalued and is now only worth 1/3,300th of an ounce of gold. It's the dollar falling more than it is gold rising. Now, gold will rise in value during these periods of time when it's basically revaluing itself. This was a lot of the premise of my first book. Jim Rickards wrote a great article, The Truth About Fort Knox and Gold Leasing, that was on Zero Hedge, but it's the end of the article that is important. The gold leasing scheme. There's another even more insidious reason why Trump and Musk backed off from their Fort Knox visit, even allowing for the fact that the gold is actually in Fort Knox. The deeper question is whether that gold is leased. And yes, it is leased. This is, I mean, I don't have the document in front of me, but I would bet anything they can't do this until the leases have been unwound. But there's big consequences, as you'll see in a moment. The gold leasing is an established market, but not well understood by non-specialists. Even experts in stocks and bonds know little about gold leasing. Basically, it's a way for a gold holder to earn a return. Gold does not pay dividends nor interest like stocks and bonds, but you can lease it to a third party and make 2% or so annually in lease payments. The party leasing the gold does not back up the truck and take it away. The gold stays in the original vault. The gold leasing is purely a paper transaction. The gold lessor gets the lease payment. The lessee gets what's called the right of rehypothecation. That means the lessee can lease the same gold to another party, and that party can lease it to a fourth party, and so on. With rehypothecation in play, 1 metric ton of gold could support 100 metric tons of paper gold transactions. At each step in the chain, a party acts like they own the gold for its own purposes of further leases or sales of unallocated gold. Everyone has price exposure and can make money make currency. If the price of gold goes up, in other words, the dollar goes down, or lose currency if the price of gold goes down, or the dollar gains a little bit against gold, but that's always temporary. The same principle applies to gold futures, gold options, gold swaps, gold ETFs, and the entire world of gold derivative transactions. The point is that the paper gold world is leveraged about 100 to 1 to the physical gold world, starting with the physical gold in Fort Knox, and I have to add West Point and Denver, because it all depends on how much has been pledged by the U.S. Treasury to the Federal Reserve in the gold notes. The danger is obvious. It's no different than any run on a bank when it comes to bank deposits. If a group of paper gold investors suddenly demands physical delivery, the counterparties will have to buy gold in the spot market since the leased gold is not in their possession. The gold market is liquid, but not liquid enough to support delivery if there were demand for more physical than a small slice of the paper gold market. A full-scale gold panic would quickly emerge. The spot gold price would go to $25,000 per ounce before an investor could yell buy. I take it that someone, possibly Scott Bessent, sat down and potentially explained the paper gold reality to Trump and Musk. Once you understand how the gold market actually works, you quickly back away from putting on a show at Fort Knox. For the masterminds of the paper gold market at J.P. Morgan and Goldman Sachs, the less said about gold, the better. They need to keep the game going. And that's why Trump and Musk won't be showing up at Fort Knox anytime soon. For the rest of us, the solution to this problem is simple. Buy gold. So that's what Jim Rickards say. I never advise people to buy gold or silver. I say what I'm doing, and I've bought a lot of gold and silver. I've accumulated, and I don't sell. And so I do believe, though, that Trump wants to go back on a gold standard, but it would require unwinding all of these gold leases first, and to unwind those gold leases, shrink. Right now, if 1 metric ton can support 100 metric tons, and this is like a maximum, I think, that Jim is estimating here. It probably isn't 100, but if the entire paper gold world, I ate an avocado a little while ago, is leveraged about 101 to the physical gold world, that means that the entire gold market is hallucinating that there is 100 times more gold out there than really exists. And that means the price is suppressed from where it would naturally be trading if they were trading real gold. But they're not. They're trading hallucinations. And so I said that the Treasury isn't leasing this gold. It's central bank gold leasing, which is a proven market. It absolutely exists. And here's where our gold is.
The insights presented reveal a financial landscape where gold, silver, and currencies are tightly bound in ways that expose both vulnerabilities and opportunities. The paper gold system, with its extreme leverage, has created an illusion of abundance while suppressing the true value of physical reserves. At the same time, governments and institutions are quietly positioning themselves, through mandates, policy shifts, and large-scale accumulation, signaling that a transformation is already underway. As traditional currencies steadily lose purchasing power and the global system strains under mounting debt and distrust, tangible assets are emerging not only as protection but also as the foundation for the next monetary era. Could the unraveling of the paper gold system trigger a rapid revaluation of precious metals and accelerate the shift toward a new monetary framework? Stay tuned. If you're interested in real, data-backed insights on the financial system, hit like and subscribe so you never miss the weekly updates. And if you follow Bitcoin-related news, consider subscribing to our other channel for more updates. Thank you for your support, and we hope you enjoy the video.